Hi friends, today we are learning about Managerial Economics and Financial Analysis, Unit number 8, Financial Analysis through the Ratios. This is useful for Triple MEC and EC students. We need to know the classification of ratios. The ratios can be classified into four types: liquidity ratios, activity ratios, debit management ratios, and profitability ratios. Activity ratio is also known as asset management ratio. Debt management ratio is also known as leverage ratio. Again, these four ratios are subdivided. That are, liquidity ratio is divided into two types: current ratio, quick ratio. Activity ratio is subdivided into two types: inventory turnover ratio and debtors turnover ratio. Leverage ratio is divided into debt equity ratio and interest coverage ratio. Profitability ratios are divided into four types: gross profit ratio, net profit ratio, price earning ratio, and earning per shares. Now we have to know the formulas for this. Current ratio. Current ratio is equals to current assets by current liabilities. Quick ratio. Quick ratio is equals to quick assets by current liabilities. Here quick assets formula is quick assets is equals to current assets minus stock plus prepaid expenses. Next, activity ratio. Activity ratio is divided into two types. One is inventory turnover ratio. Inventory turnover ratio is equals to cost of goods sold by average inventory. Here cost of goods sold formula is sales minus gross profit. Average inventory is equals to opening inventory plus closing inventory by 2. And next, debtors turnover ratio. Debtor turnover ratio is equals to credit sales by average debtors. Here credit sales formula is gross credit sales minus returns. Average debtors is equals to debtors at the beginning of the year plus debtors at the end of the year by 2. And next one is leverage ratios. Leverage ratios are divided into two types: debit equity ratio. Debit equity ratio is equals to debit by equity. Here equity means it includes share capitals, reserves, and retained earnings. And debit means outsiders, is nothing but outsiders: bonds, long term loans, and debentures, etc. And the next one is interest coverage ratio is equals to net profit before the interest and taxes by interest. And next one is profitability ratios. These are divided into four types. Number one, gross profit ratio, that is equals to gross profit by sales into 100. Here the gross profit is equals to sales minus cost of goods sold. Next one is net profit ratio. Here net profit after the taxes by net sales into 100. And next one is earning per shares. The formula is net profit after taxes by number of shares outstandings. And the last one is P by E ratio. It is nothing but price earning ratio, that is equals to market values per share by EPS, earning per shares. By all these formulas we will do some problems which are related to these formulas. I am sure that after you are getting these formulas, you will get minimum marks from this unit, that is up to 10 to 12 marks you will get. Thank you for watching this video.